What is ETF and how is it different from mutual fund? ETF and index put together, passive funds. The assets under management are roughly 11.75 lakh crore.
You gave me a lot of examples of ETF. How do I actually go about it?
How do I choose which ETF? We came out with this framework. It's called Victor. VICTER. It's a short form for the number of folios. We have 4 crore in ETF and index put together, and in the mutual fund put together it's roughly 23.5 crore. In the very near term we are likely to have hybrid ETFs.
Hybrid ETFs, what are that?
Which is
Hi Mr. Arun, it's such a pleasure to have you at HDFC Securities office today. Thank you so much for taking time out of your busy schedule. Welcome to Make Money Matter. It's a podcast on finance. Here at Make Money Matter, we believe your money is not just to sit at your account, but to build the life you wanted. And that's what this podcast is all about, for smarter investment and smarter financial habits. And today's episode is on a topic which a lot of people know about. They're aware that this thing exists, but they don't truly understand it, which is ETF. And I'm someone who's in their early 20s, but I have never invested in an ETF. And I'll tell you why. It's not like because I'm a Gen Z and I do not understand about finance. I've been doing my SIPs since the age of 15. So I've been very consistent with my investments. But I've always invested in mutual funds because in my head, I felt like, okay, I understand mutual funds are a basket of stocks. ETFs are also basket of stocks. So why should I invest in both? So let's just begin with that. Can you explain it to me in layman language? What is the difference between mutual funds and ETF?
Thanks for having me on the show. Really looking forward to this conversation, and I sincerely hope that the viewers, including you, find it useful, and probably at the end of the session you have all the clarity to go ahead and invest into ETFs and other passive offerings. Now, to start with, you asked what is ETF and how is it different from mutual fund. ETF, exchange traded fund, is also a mutual fund. There are technical differences. I'll come to that.
Okay.
It is a mutual fund. The main difference is that this is listed on the stock exchange, and therefore you'll be able to transact during the day. Just like how you do stocks, you buy and sell. And there are different aspects of stocks you do, right? You do, limit order, market orders, margin trading. All of that can be done in ETFs. Again, the main difference is that a stock is a single security. ETF is a set of stocks. It's a portfolio that is listed on the stock exchange, but end of the day, it's a mutual fund, which can be transacted on the exchange. It's fairly simple. Of course, there are nuances and the technical aspects which we will explain as we go along, but fairly simple and straightforward, just like stock in
Okay.
lot of ways.
So you're saying all ETFs are mutual funds, but all mutual funds are not ETF. Is that a correct statement?
In a way, yes. Mutual funds, not the open-ended mutual funds, are not listed.
Okay.
So therefore you'll be able to transact only based on the day end NAV.
Okay.
Suppose you take markets, Nifty, right? Any day, or for that matter, any part of the market, it can have lot of volatility during the day.
Okay.
Right? It can sometimes during the market go up by 2%, 3%, but end of the day it can end up flat or vice versa. A lot of changes happen over a period of time, right? Now, ETF allows you to transact at any point in time. Suppose you decide that at 11 o'clock I want to buy because the market at that point in time is down, and you think that it's a good price to enter the markets, you can do it in ETF. Whereas in a normal mutual fund, you can still buy, but it will happen at the end of the day. By the time the market which was down could recover, and it can end up being possibly 1%, 1.5% high. So ETF gives you the exact control of when you are entering into the market. Similarly, when you want to sell, like for example, you had a target in mind, your investments have reached exactly 15% at a point in time, like 11:30, you go and decide to sell. That kind of control you may not have in a normal mutual fund. So that's the main difference.
It is a simple product. I agree. And a lot of people out there, they know about mutual funds. Like a lot of my friends, they're like, okay, we have our SIP. I asked them where it's in, and they're like, it's in mutual funds. But I've never heard anyone saying ETF. I feel like there's a lot of misconceptions with the product. So what do you think, according to you, is like one of like some of the most common misconceptions out there for ETFs?
See, first of all, the mechanisms are different. So for ETF, you need to have a demat account.
Okay.
Right? And this trades like a stock. A mutual fund, even if you don't have a demat account, you can make investments. So to that extent, it can be considered to be simple or otherwise, right? So somebody who's familiar with investing into stocks through their demat, they'll find ETF investing as, convenient and as simple, right?
Okay.
The main difference being this is one stock and here it's a portfolio, right? So to that extent, it's very, very simple. This is not a very, in a way, a distributed product. So in mutual fund, for example, you have a lot of, individual distributors, banks reaching out to individuals, explaining and, telling them how to go about making asset allocation and investments. So ETFs may be more do it yourself. Like, one needs to possibly have that basic understanding about market.
Just because there's so many ETFs out there, it sometimes gets overwhelming for the retail investor. How do I actually go about it? Okay, now I understand what ETFs are, how they function. I know all about it. Now I want to go and check out which ETF to apply for. And maybe they know that they want to apply for a sector-specific ETF. But what are the key metrics that they should look at while making their investments?
Okay. So I'm going to give you a slightly longer response to this, but I think it will be useful for our viewers. Basically, there are 4 categories of funds, or rather ETFs, right? One is equity. The second is debt. So that's again a good category. If somebody wants to invest into fixed income, there are opportunities. There are choices in the ETF format as well. Third is commodities. You have gold and silver ETFs available. And fourth is liquid ETF. So somebody who's very active into stockbroking can use liquid and use that to, instead of cash, you make investments in liquid, earn returns, and you redeem, you invest into stocks, and vice versa. You can do that, right? Now, these are 4 categories of ETFs which are available. Within each class, there are sub-varieties. There is sub-asset class. For example, in equity, there are 4 types of ETFs available. One is broad-based ETFs, where you have Nifty, mid-cap, large and mid-cap. These are all market cap-based products, right? Simple to understand. Everybody understands large cap, Nifty, mid-cap, small cap, etc. This is number one. Second is sector. Like we already talked about it, bank, IT, pharmaceuticals, auto, reality. So any of these sector you have a view, either strategically or tactically, you can invest into them. The third type is thematic, consumption, rural, infrastructure, defense. These kind of themes are available. And the last one is what is called as strategy or smart beta ETFs. See, for example, I want to play the value strategy, right? I think that value stocks will do well, or I think that quality as a strategy will do well. There are ETFs which allow you to do that, quality, low volatility, or alpha, or even combinations, alpha and low volatility combined. So these are all different types of equity ETFs which are available. Coming to fixed income, there are 2 types. One is what we call as target maturity funds.
Okay.
Very simple, more like your FDs.
Okay.
Today we are in 2025. Suppose you select a 2028 maturing target maturity ETF.
Okay.
Right? In a way, it's like investing into a 3-year FD.
Okay.
So the underlying will be bonds, or it can be government securities or state bonds, right? So you have the option to stay put for 3 years, in which case, whatever is the current yield, more or less you're likely to get that, right? These are all government securities and state bonds. You will not have any defaults. Even the corporate bond, only AAA rated, the highest rated corporate bonds are allowed in this particular category.
Okay.
But in the meantime, if you want to take, you can do that.
Okay.
It's meant for 3 years, but after 1 year or 1.5 years, for some reason you want to redeem, you have the option to do it at market prices, right? So this is one variety. The other variety is constant maturity. Like for example, there is a 5-year gilt ETF.
5-year gilt ETF.
Yeah, government securities
Okay.
ETF,
Okay.
which invests into Government of India securities. But the maturity of the papers is at all points in time around 5 years.
Okay.
So you take a call, likewise you have for 10 years or for that matter, any constant maturity or duration, right?
Okay.
So this one is not like, you invest for 5 years, it will give you a particular duration, right? It's like a debt security, you make investments and, it can work from time to time, right? So this is number 2. Commodities, you have gold and silver. Both are fantastic asset classes. They behave very, very differently from equity or any other traditional means, right? So that's there. We already spoke about liquid. So you have a variety of them, right? Now, how do I choose which ETF, right? We sometime back, came out with this framework. It's called Victor, VICTER. Victor. It's an acronym. It's a short form for what we think are the important parameters. V stands for volume. Okay. So any stock or ETF, the higher the volume, the better. So if I say there are 2 ETFs, one ETF is trading 200 crores per day, and there is another ETF which is trading only 5 crore per day, there is a big difference. Obviously, you should choose the 200 crore trading. Right. So higher the volume, the better. This is
There will be more buyers there when you decide to liquidate your ETF.
price will be closer to the intrinsic value.
Correct.
Right. It should be liquid. There should be buyers. When somebody is buying, there should be someone selling. So that natural volume has to be there. Right. That's when the ETF is likely to be efficient. Right. So that is volume. The IC stands for impact cost.
Impact cost.
Okay, which is a direct, fallout of volume. Higher the volume, lower will be the impact cost.
Okay.
Now, what is this impact cost? What we are saying is that suppose the value of that, let's say it's a Nifty ETF. Suppose the value of the Nifty ETF is 100 rupees.
Okay.
100 is the NAV, for example. Okay. Now,
What is NAV? Can you explain that?
NAV is net asset value. So,
Okay.
You have Nifty, you have 50 stocks, right?
Okay.
So there is a value for all the stocks, isn't it? Like, you have HDFC Bank 13.5%, you have RAL 9%. So likewise, what is the value of the basket at any point in time? It can be 100, next minute it can be 100.2, market, just like stock.
Just like stock
right?
price. Yeah.
So this ETF has this value, which is nothing but the value of all the stocks put together, right?
Okay.
So this is at 100.
Okay.
Now, when I go to buy, I should be at that point in time, if the intrinsic value, we call it INAV, indicative net asset value, which is nothing but at that point in time, the value of all these 50 stocks in that proportion put together, suppose that is 100.
Got it.
Now, when I am going to buy, I should be able to transact close to 100. Now, for some reason, right, instead of 100, if it starts trading at 102, it's like I'm paying 2% more, right? Now, why is that happening? Because this ETF is illiquid. There is no natural volume. So it is trading at a higher price than what it should be. There are more buyers. There is no seller.
Okay.
Okay. And that is why it is trading at, instead of 100, 102. The actual value is 100. So if the apple is costing you 30
There's demand
rupees,
and supply, basically.
right?
Yeah.
You will not pay 35, right?
Yeah. Yeah.
Right? Now, therefore, in a way, when you go to buy, instead of 100, if it starts trading at 102, you're paying a bigger price. So that concept is impact cost, right?
Correct.
So higher the volume, the impact cost will be lower. You'll be able to transact very close to the intrinsic value, which is your 100, right? So you should look out for lower impact cost. So when you're comparing, and these numbers are available. So if you go to the websites, NSE or BSE, and type out a particular ETF. Suppose you are exploring 2 different ETFs to invest, right? You go and check what is the volume, you go and check what is the impact cost. You will be able to easily find that out. You just have to type the scheme and the code and see for yourself, right? So this is impact cost. The T stands for tracking error. Okay, tracking error is again a technical concept, but in a way what it says is that if the underlying benchmark, or in this case let's say Nifty, if Nifty is giving a certain amount of returns, like on one day it gave 1%, next day it gave 1.5, third day it was minus 1.2, right? Every day the ETF also should be tracking that. Okay, there will obviously be some difference, okay, due to expense ratio and a few other things. There can be some difference, that's fine. But if every day the difference is going to be different, one day it's more, one day it's less, so this data is going to be very volatile. Every day, the ETF is behaving differently than the underlying index.
Okay.
So in that case, it will show us a higher tracking error.
Okay.
Right? Which means in English terms, it is not tracking the index properly.
Okay.
Right? So that is also not a good thing.
So the lesser the tracking error, the better.
Obviously.
Okay.
Right? Lesser the tracking error,
Okay.
the better. Right?
Okay.
And this is also available. It is published in the AMC websites and in a lot of public sites as well. So somebody can just quickly, when they do a comparison, what is the tracking error? You can check that. So volume,
Impact cost, tracking error.
T is tracking error, and the last one ER is expense ratio.
Expense ratio. Okay.
Which is the cost you're paying, which is a direct cost. Okay.
Okay.
Impact cost is an indirect cost. In my opinion, in fact, in ETFs, impact cost is a bigger element or a bigger parameter to consider than even expense ratio. It could be possible that one ETF expense ratio is less, but because it is not liquid, the impact cost can be so high that it will negate all the advantages of a lower expense ratio. Therefore, all these things will have to be considered. But of late we are seeing good growth in terms of ETF assets under management, the number of investors investing and stuff like that.
Can we put some numbers on that? Like how if the space is growing very fast?
Yeah. So the
in
ETF,
last 5 years or in last 10 years, how fast it is growing?
Yeah. So ETF and index put together, passive funds. So
Passive funds,
index
sorry.
is another format,
Okay.
which is like mutual fund,
Okay.
but there is no active fund management involved, not listed. You do end of day, but essentially it's a passive product. ETF, we already are speaking about it, right? Both put together, the assets under management are roughly 11.75 lakh crore. 11.75 lakh crore.
crores. Okay.
And this right now accounts for almost 17% of the mutual fund industry
Okay.
assets, right?
Okay.
That's almost 17%.
This data is publicly available.
Yeah, publicly available. And the number of folios is a proxy for the number of investors. So we have 4 crore folios in the passive
Passive
in
ETFs.
ETF and index put together. And in the mutual fund put together, it's roughly 23.5 crore. So again, even in terms of number of investors folios, it's approximately 17%, which is not a small number. Like, we are talking almost 1/5 of investors, or in terms of assets under management, lying in the passive. And specifically when it comes to growth, for example, in the last 5 years, if you look at the growth rate, the passive AUM has grown at a CAGR, compounded rate of growth of nearly 50%,
50%.
50.
Okay.
If you leave out passives and look at other schemes, they've grown at 23%. So basically,
If we leave out passive, that will be just active, or other than active,
Yeah, the
commodity
active.
and every other.
commodity, gold and silver also is
Okay.
available only in the passive format.
Okay.
Right?
Okay.
Right?
That will be part of passive.
Correct.
Okay.
So the passives have grown at 50%,
Okay.
whereas the rest of the funds have grown at 23%, which means passives have grown at twice the rate as the other part of the market, right? So India, the trend, obviously growth has been picking up. Already there are a lot of options, but as I said, they're limited to fully replicated, or rather, no fancy products right now. In the very near term, we are likely to have hybrid ETFs.
Hybrid ETFs. What are that?
Which is a combination of equity and fixed income in the same product.
Okay.
Okay, so we talked about them separately, right? Equity, fixed income, right? So it can be a product where maybe 65-70% can be equity and 30% can be fixed income. So it gives you asset allocation. You don't have to worry. You don't have to separately invest in equity, fixed income. You have decided for whatever reason that given your age and given your requirement, whatever it is, that I need a good amount of equity, but I also need fixed income. These kind of products, likewise reverse. Suppose, you want to say 70% fixed income, 30% equity, or 50-50. These kind of hybrid ETFs are something that we can look forward to in the near medium term.
Okay, understood. Well, that brings us end to our episode today. Thank you so much, Mr. Arun, for such a rich and insightful conversation. You definitely made ETFs less intimidating for me. I can say for sure I understand ETFs much better now. So thank you so much. Thank you so much for being here with us.
Thank you, Tanmay. Looking forward to your investments to start with. I hope you found it simple, and so did our viewers. Thank you very much.
Thank you very much. Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.